Hello, everyone. Ladislas Maurice from the wanderinginvestor.com. So today I'm really excited to be talking to Trader Ferg. How are you?
Great, Hank. Thanks for having me on. I really enjoyed the last time we chatted, so it's a pleasure to be on your show.
Fantastic. So the topic today will be anti-ESG. So we're all aware of ESG investing. We see it in mainstream news. It's what people like to invest in these days. The green revolution, green energy, wind, solar, etc. It's all great for the environment. And the other side is oil, coal, commodities. They're all very bad for the environment, and we shouldn't put our money there because they're only going to disappear from the economy and people are going to lose a lot of money. That's essentially the narrative that we've been fed by mainstream media for quite a few years. But Trader Ferg, who's one of my favorite Twitter follows, I really enjoy following him on Twitter, has been doing really interesting trades by going against the whole ESG narrative. Let's start off with coal. Coal is literally the most hated commodity out there. Just look at this cover page from The Economist. It's a pretty good contrarian indicator in many cases, just looking what The Economist talks about on their cover pages. So were you to look at this, you'd think, yeah, you would never invest your money in coal, but Ferg went the other way and invested very heavily in coal in spite of the whole narrative. So here's a chart showing the price of coal. Look at when The Economist talked about it late 2020 and look at coal in the last few weeks. So it's gone parabolic. And a lot of these coal stocks have built-in leverage. So from a stock point of view, it's been going up even more. So Ferg, you were mentioning some stocks. There are already some 4 or 5 baggers in there easily. So how did you come about going into this trade and how did you play it and when did you get in?
So the first thing is just when you see something that isn't based on economics. So I'm always attracted to something that's based on sort of ideology. And I think a lot of what we're seeing with like renewables, especially wind and solar, when you dig into it, it is really in ideology. It isn't working. Anywhere you look, like you can just use the pilot programs, which suggest to like Germany or California and see the result they're having. Or you can even some of the more interesting ones are the ones that actually work, like Denmark, where they've got quite a high percentage wind, and people sort of hold that up as, look, they're just fine with sort of a north of 60%, 60% of their systems wind. But then when you dig into it, you realize that they import up to sort of 50% of their power from Norway or Sweden, which are using obviously hydro or nuclear. And so there isn't the sort of this IEA dream of like running everything on sort of 90% plus. Wind and solar is exactly that. It's a pipe dream. And so once I kind of worked through that, then it's kind of working back to, if wind and solar aren't going to grow at the rate we are, what's going to have to like pick up the slack here? What's going to be the outcome of them not growing at the rate that sort of everyone expects them to? And when you get to that, you sort of arrived at sort of everyone likes to think that gas will be the bridging technology. And the interesting thing with gas is everyone loves to extrapolate recent prices. And what we had with gas was somewhat of a gas glut around the world. And that was a result of shale. And shale essentially being run on sort of coming back to sort of non-economic factors. It was just trying to produce more rather than worry about profitability. And so as soon as kind of had a bearish view on renewables and a bearish view on sort of shale in general, which are all also a symptom of like easy money essentially, then started sort of going about how to get the most leverage to the sort of these falling short of the sort of the percentage of the global energy mix that people thought they'd make up. And so some of the obvious ones coming out were some of the gas plays. So one of my favorites early on, thanks to Contrarian 888, was Ontario Resources. And then came to the sort of conclusion as well that it's kind of my style. I like to look for what's the most hated because that's where the most sort of asymmetry or payoff will often be. And by far the most negative sort of at the start of this year was probably coal. And then if you want to get the most asymmetry out of an already sort of hated sector, then you probably go to the ones that are sort of teetering with bankruptcy within that sector. And so that led me to the likes of Peabody. And so Peabody was actually quite interesting because that was sort of, it sort of provides north of 5% of US power, and yet it was, they were threatening of a second round of bankruptcies of Chapter 11. So went into Chapter 11 in 2016, and that was an interesting Chapter 11 because they actually had the cash flow, they just couldn't roll their debt, and that was just because kind of what's happening in ESG is just cutting whole sectors off from capital, and it's one of the reasons I'm so bullish is when something's necessary but it gets cut off from capital, just means prices have to go higher to and they'll have to fund it out of sort of cash flow. And yeah, I'll sort of dig into that, I guess, in a sec. But coming back to Peabody, it was interesting because that was the most sort of negatively priced. They were in talks of going until they essentially put out that they could be facing a second bankruptcy, but that didn't really stack up when looked at Elliott Management had bought about 30% of the equity, and they were just trying to get some of the debt holders to take a haircut. Once they forced that through, then it was just, once that all the debt got extended out, then that was just sort of a prime trade, and that's what that was my largest coal position, and that's been just had a tiny free float, and that's been squeezed to some pretty crazy levels now. And I don't sort of think the trade's done until we could possibly get some crazy gas pricing this winter. And for anyone that doesn't kind of understand the dynamic, it's something known as switching. So kind of the higher natural gas prices go, it's sort of an incentivized coal use because they're just what do you call them? They're competitors. And so if gas gets too expensive, then you switch to coal. And it's what people didn't really realize was happening with the gas glut is they sort of patted themselves on the back in many developing countries because gas was so cheap, it disincentivized coal, and everyone kind of aligned it with ESG working and coal going out of use. But take this year, I think gas was meant to be about 40% of the US energy mix. And because gas prices have spiked, it's about 5% lower. And that 5% has moved to coal. So coal was supposed to be at about 20%, and it's up to about 25%. And so that's been an absolute windfall for the likes of Peabody, especially coming off pretty much being priced for death, like having a 60 to 70 million free float when it's, yeah, as I said before, sort of north of 5% of US power. That just made it a great trade. But that isn't kind of, like I've written about this before, but it's not really the coal trade, because the coal trades, I kind of compare it more to the tobacco trade in that you generally won't get multiple expansion. So with most funds, they have ESG mandates and just general negative sentiment. Like most people just hate the idea of even investing in coal. And so you probably don't get a lot of these companies repriced multiple wise. They're just gonna have to cruise along. But then, as the chart you showed before, because the prices are spiking, that cash flow has to go somewhere. And so it's either going to come in form of dividends, it's going to come in the form of share buybacks. Some companies that I really love, like Whitehaven, for example, they've got quite a few projects in the pipeline. They'll be able to fund that all with cash flow. And so it creates something that I like, is it's kind of I think it's a tobacco trade all over again. You'll just get good, steady sort of share price appreciation over the next decade, which is a nice hedge against some of the more sort of boom bust sectors that we talk about, like uranium, where it could go parabolic. Yeah.
So you're saying that this price spike is sustainable and that it's not just a spike, it's actually just the beginning of a re-rating of the price of coal, and that you personally for your own portfolios see yourself keeping in a lot of these shares into the medium long term, not just into the depth of winter and then off to the next thing?
Peabody probably, well, not now, it's pulled back significantly, but it got ahead of itself. But yeah, Peabody was more of a sort of a post Chapter 11 play. But when I'm talking about the likes of, so to give you some sort of valuations with the likes of Whitehaven or New Hope, are two of my favorite. You can kind of work them out on like EV to EBITDA. And so they're coming down. With the current coal price, you're nearly buying them at sort of 1 times EV to EBITDA. So you're nearly getting, it's kind of like buying an apartment and getting the cash flow for what you paid back in a year. And so once you're working with that, it makes it difficult to go wrong. Do I think coal prices stay this high? Well, I don't see them coming down going into this winter, but are they sustainable here? Probably not, but it doesn't really matter. You're printing money if they pull back by a third, 50%. They're still phenomenal buys.
Yeah, because the futures for coal are quite high into 2022, 2023 now.
Yeah, exactly. It's kind of funny. It's almost the opposite of, or it's another big opportunity that we'll probably get to is how backwardated the oil market is. It's kind of the polar opposite of that. Coal, you got futures holding up right out the curve, whereas oil kind of falls off a cliff. So you've got the front month quite high, and then you've got like 24, 25 in the sort of 50s, which is just a huge opportunity in itself. Like just the energy markets are a mess, and it's quite interesting because everyone thinks of energy in terms of temporary disruptions. So it's all we've ever known. It's like, say, use like a oil embargo. There was always a surplus of sort of oil capacity going out, and there was just a disruption which sent the price through the roof. Same can be said for the likes of uranium. Like the flooding of Cigar last spike was just a temporary disruption. But what we have now in the oil market and the uranium market as well is we have structural deficits, and these structural deficits are going to take years to fix, maybe even a decade to fix. And so that presents quite a different sort of a setup. So yes, your standard sort of price spike won't fix anything. And so coming back to coal, it's if we're going to see a lot of these things stay elevated, you hold the sort of bearish view of renewables' ability to scale, which can dig into as well, then yeah, a lot of these things are going to stay far more elevated than everyone would have you believe. Lastly, it's always important to separate out developed markets and developing markets of coal, because you'll see charts that show like coal's terminal decline and it shows it falling off a cliff. Those are generally based on developed markets. So you can show some pretty steep decline rates for sort of Western used coal. Like it has definitely been phased out in Europe. I wouldn't argue with that. And it's been slowly phased out in America as well, probably a bit slower. But it's more than offset by the growth in Asia, and China's just building it at a rapid rate, and so is the rest of South Asia. And the sort of pipe dream that a lot of them will pick up renewables is just that they're not well suited to renewables. They've got low wind speeds. They've got and they've got large coal reserves. So it's almost asking them to give up their energy security. And why would they when they're looking at the sort of pilot programs that are Germany and California? So that's a big overview, I guess.
The Energiewende in Germany has been a complete and utter failure, courtesy of Merkel. So China made headlines recently with coal, stating that they will not build any coal plants abroad anymore. So that was seen as a negative point. Some provinces within China are also putting an end to the construction of coal power plants. So is this a risk with regards to your thesis, or is it's just too small to matter, seeing the amount of coal power plants that are being built in China and India, for example?
Yeah, well, the interesting thing of this is it's definitely negative. Like, I'm not going to spin it as it isn't. And it's a bit sad, if anything, because the countries that are going to be cut off from these projects are they don't have any economic alternative. So this is a lot of Africa that's going to be cut off. If anyone wants to look it up, you can look at coalfinancetracker.com, and it shows where China's financing coal projects globally, and it's mostly in the poorest of the poor countries. So yeah, they're going to cut off a lot of the finance of these guys, and they're not going to have economic alternatives. They're going to have to finance it internally, which will take a lot longer, and it's going to cause a lot more poverty, because kind of enabling kind of cheap electricity goes hand in hand with sort of longer, a higher quality of life, hospital care, reduced mortality, reduced child mortality, yeah, all of it. And so it's sad from that angle, but from it sort of impacting the thesis, it's quite interesting, because what's happening is, yes, the demand side's taking a bit of a hit there, but we're seeing even more destruction on the supply side. So it's kind of a balancing act. And what's interesting is a lot of the coal reserves are actually in the strongest ESG countries. So I've talked to a few coal CEOs, and they're just getting their permits like rejected. And so when you consider like Australia, they're just sort of on the warpath. There's a great article you can look up where a few teenagers and a nun have taken some of the, I think it was Whitehaven, to court, and one that won the decision, but they didn't get an injunction, but one that essentially developing any coal is sort of risking their children's future. And so all I read from that is they'll have a really hard time getting permits across the line in the future. Stuff that's already permitted probably still gets through, like what Whitehaven has, but yeah, you're going to have a really hard time. Same goes in Canada. And then you have what's happening in China, which has been, if you pay close attention to the sort of the state-owned especially the Chinese coal sector, they've been whipping it, saying to increase production for the last few quarters. And every time they sort of demand that it increases production, you wait sort of for the next quarter and it decreases. So they're really maxed out, and they've especially shot themselves in the foot with what they've done with sort of Australia more recently, and that's caused a lot of this sort of price action, which has been also reinforced by higher gas prices as well. So in short, like the supply destruction is outpacing the demand destruction, and that's, if you wanted it sort of in a soundbite, that was be how I would state it.
Clear. Cool. Thank you. Let's talk about oil now. Oil has also been making headlines. I mean, we all remember in March 2020 or April 2020, oil going into negative, and everyone was bearish. It went up. You can see the graph here was flat around the 30s, 40s for a bit, and then recently it started going back up. Even though we've been seeing large companies like BP, like Shell, the majors cutting back on exploration, committing to a net carbon neutral future, whatever that means, saying that they're going to go into renewables, etc. So moving away from their core business. And now we're seeing also oil going up. Do you see this as temporary, or do you also see this as structural?
Most definitely structural. So yeah, you just use BP as an example. That's the sort of transition to green companies is just the most efficient way I've seen to destroy shareholder capital. It's just they're essentially fire sailing all their carbon intensive assets and going and paying record amounts. Like they won a bid in a wind auction, I think it was last year, for double the previous price. And so it's just the last thing you'd want to see. And so it's kind of sad, because a lot of it's something that's like a bigger theme is the fact that everyone's so enamored with passive, it actually becomes a stock pickers market. And so even people that kind of understand that they should be long commodities, it's actually really hard to do it via just like an index or an ETF. Like even if you buy an oil ETF, you're getting all these oil companies that are trying to transition. And even if they resisted the transition, then they kind of got the likes of Exxon with engine number one. And so it was the fact that this tiny little hedge fund had like 50 million in Exxon, which is obviously multi billions, and they should never have really had much of a case, except that they got backed by the likes of BlackRock and Vanguard. And so all these big passive holders of the oil majors, they support the sort of ESG push, and so they obviously won 3 board seats in the end. And yeah, they're pushing for a sort of a shift to green energy, and pretty much starving any idea of sort of reinvestment. And this isn't even expanding the reserves. This is just like maintaining. Like with oil, you've obviously got to replace yearly what you're using up, and so they're not even replacing. There was a great paper from JP Morgan a while ago, and that was saying that all the oil majors would need to double their capex just to keep that sort of decline, to stop their decline rates without adding anything. And so there's some great charts out there for showing just how steep the decline has got. And this is like, if I was to try and
even if they doubled their capex, there just probably wouldn't even be the spare capacity in terms of manpower and machinery.
Yeah, exactly. Yeah, well, that's another topic itself, is that once you lose a lot of like the specialized labor as well, with like I think BP's fired a ridiculous amount of people. I think it was 15,000, 20,000 of their staff, and they all go out and find other jobs. And yeah, it's just this sort of brain drain of the sector. But just trying to like paint the big picture with oil. It's just to kind of use big numbers. It's before the pandemic, we were using about 100 million barrels a day, and it's obviously pulled back with COVID. But what's interesting is if sort of the decline rates are pretty steep. So if you were to take it out to 2040 or 50, you're somewhere down around like 20 million barrels a day. That's like the sort of the trajectory we're on currently, and we're not doing anything about it. And everyone likes to say it's going to roll over, but as I've always kind of pointed out, one of the most steady sort of growth curves, or consumption sort of growth curves in the world, is oil usage. So you can take it right back to the sort of the 60s, and we've always added sort of 1%, maybe a bit over 1% to oil consumption per year. And so it's always adding slightly over 1 million barrels a year. And so every year it's that 100, 101, 102, 103. So you take that forward, and by 2030 or 40, you'd be up somewhere around that, sort of somewhere between 100 and 130 and 140 or something, and match that with that decline rate. And so that's the kind of the picture. And of course, everyone will try and tell you that there's all sorts of reasons that oil demand is going to be offset by renewables. You only have to look to like the Cathie Woods telling you that oil's pretty much dead in the water, which is always just fine, sort of almost comedy. But it's and this is again similar to the point I made with the developing world. The developed world's only 1.6 billion people, and we use like 13 barrels per person per year. And the developing world, so that's 6.5 billion people, they use sort of 3 barrels per person per year. And the interesting thing is, the developed world, we're kind of going nowhere demographically. We're not going to grow much. But the developing world, they're probably going to add, like most estimates are about 2 billion people by 2050. And so even if you just take that 2 billion people and keep it at status quo, you don't allow them to increase their standard of living at all. So you hold them flat at that 3 barrels per person, then you add 50% to the whole energy system. And if you assume they kind of all join the middle class and get up to, take a guess, 4 or 5 barrels, then you can come up with some pretty crazy numbers for how much the energy system needs to grow. And so it's absurd that we think that we can roll over sort of oil demand. And we're setting up for a sort of an energy crisis with the current decline rates. I think what we're seeing now with gas is we'll be seeing that with oil in inside another year.
If you want to play the oil market, Western major is essentially not really the way to go because of all the internal ESG pressure they're facing. Oil ETFs have too much exposure to these oil majors. So how do you play it?
There's a few ways. I've been quite vocal about the offshore sector. So the offshore sector is interesting, as it's a bit more of a sort of an out of the money call option on oil. So a lot of these things don't make much money until oil's higher, and then all of a sudden they'll all be needed. And when they've been priced for death, that's when you kind of get a really nice re-rating. And to give you an idea, like 50% of the proven reserves of oil majors are with offshore. So everyone that says, oh, who knows if offshore will be needed again? Well, if we agree that we need oil in the future, then we're going to need offshore. And then you've got a lot of these things have been essentially priced for death. And that was always one of my sort of things I wrote about sort of the earliest on, was how to get sort of how to get the lowest risk sort of play on oil. And that I think has been in playing the offshore companies that are coming out of Chapter 11. So the likes of Valaris, Tidewater, Noble, they all essentially wiped out their debt. So these were the sort of nature of the business is they're very asset heavy, and so they take on a lot of debt, and so they're quite leveraged. And all of them kind of went bust, bar sort of Transocean and a few others. And now you've got them back with without the debt component, which kind of makes them low risk and with significant upside when sort of compare them to oil majors. I'd sort of say that's kind of the foundation of my portfolio is those. And then you've got some super attractive plays in sort of Canada, ones that are sort of just cash flow cows. Like they're very profitable at sort of $60 to $70 WTI. And so there's some, I should follow Eric Nuttall. He's a Canadian energy fund manager. He's got this great chart of the years it'll take to recover for them to pay off all their debt, buy back all their shares. And some of these companies are like 3 years, 4 years, and they're going to produce that much cash flow. And this is just at $60 to $70 WTI. And so those are super attractive. But I think the most attractive play of all is it's a bit more complex to put on, but it's something Cuppy's talked about a lot, is doing it's going out the curve on WTI future options. And so you've got something known as backwardation, where it's just where the front month is far higher than sort of going further out the curve. So say sort of like where are we now in the 70s on the front month, and then you sort of go out to 23, 24, 25, and you sort of drop into the 50s. And so you can buy sort of bull call spreads there. I've recently got filled on sort of, I think it was 95, 105 out in December 24, and can sort of set up a payoff, which is about 14 times. And I think that's, you can obviously get more aggressive and go further out, but for something that I see that's highly likely, and yet that's like priced like it's very unlikely, then I want to really lean into trades like that. So I find that super attractive. But yeah, for anyone that doesn't want to mess with those, then I don't think you can really beat some of the cash cows that are in sort of Canada and some of the sort of the Tidewater, Valaris, Noble. I really like MMA offshore. I think that'll have a lot of torque. And some others, Saipem, they've got a great option market as well. Yeah, there's lots of plays like that have just been absolutely bombed out. And funny enough, I think they're lower risk and provide far more upside than the majors, which is interesting.
Interesting. What about Russian oil companies? Because they don't deal with a government that's all pro ESG. They can do business, they can drill, they can explore, they can export. Have you looked into those?
Yeah, I think if I had, I'm just a bit more aggressive, younger, and obviously want to really knock it out of the park on the cycle. But I think if I had more of a pension portfolio, I'd definitely have Lukoil, Gazprom, some of those. And I think I would have, had a question on Twitter a while ago, like what's what's everyone's favorite like non-ESG kind of oil play? Like what's an oil play in a country that isn't really caring about ESG? And there's some good names, but ultimately you still have a lot of operational risk. And if I can't match that up to the payoff I'm getting on the WTI bull calls, like why bother? There's also sort of a cutting out the debt risk, the operational risk, and playing the commodity straight. It's pretty attractive. And so yeah, I keep hunting around the world and keep coming back to buying more of those. Yeah, getting more aggressive on that. And I think it's one of the last sort of trades to run as well, because we've obviously seen uranium's taken off, natural gas has taken off. Anything in the coal space that was going to go kind of parabolic has taken off, and the rest of it will be like steady grinders higher because they won't get multiple expansions. So I think oil is really the last one that's gonna the spotlight's gonna get put on it over this winter and in the coming months. And yeah, you'll see it start to re-rate.
So the mainstream narrative coming out of a lot of investment banks is that we're not going to see an increase in the price of oil anytime soon because there is a lot of spare capacity with OPEC plus. So Russia has a lot of spare capacity. Saudi Arabia has a lot of spare capacity. What's your take on this?
Yeah, so for anyone interested in this question, they should just go to Josh Young's website, buy some interest. So I actually just sent this out in my newsletter yesterday, and he's wrote a whole like white paper on this. And so he's dug into, you kind of see it if you were paying attention with Russian exports. So they've had higher quotas and yet they don't meet them. Their production keeps falling off. And so why are they not meeting their quotas? And Josh kind of breaks it down that they've got a lot of old rigs and they're just experiencing decline. They haven't invested enough, sort of same old story, and it's really starting to bite. And he thinks it's going to take a lot to sort of turn this around. And so there's sort of spare capacity that's supposedly there. It's a myth. And the same goes to Saudi. He's sort of saying there's been an interesting dynamic where they've always sort of said they've got this extra 2 million barrels a day of capacity, and yet every time they've sort of got anywhere near it, they start drawing down their inventories very quickly. And so it's kind of quite convenient that they always kind of held it over everyone's head as we're underproducing and we'll overproduce if you don't sort of meet our terms. But yeah, the fact that they draw down inventories every time they get close to even digging into that spare capacity, thinks it's probably not there. And it's quite interesting. Like when you dig into what kind of happened with Aramco, I think it's a fascinating little story. If you don't mind a little tangent with that, sure. is when they were trying to sort of price it and get the IPO, and they wanted their $2 trillion market cap for Aramco, and most the sort of investment banks looked at it, sort of said, "You're joking. It's sort of the most we could give this is sort of somewhere just over $1 trillion." And so that wasn't MBS wasn't going to take that. So what he did is just sort of IPO'd it in their domestic market, got a whole lot of sort of rich Saudis to prop it up, and of course they're not going to sell it and then sort of price a secondary off their sort of artificially high price in their domestic market. And so they never really got their books kind of reviewed by sort of an international. And so that's kind of another angle that sort of minces together with Josh Young's take that they don't have that extra capacity they're claiming. And so it's all a bit overstated. And so what you get out of that is you come back and you say, oh, this supposed 2-3 million barrels a day of spare capacity that come on and make sure everything's smoothed over probably doesn't exist. And so if you take that view, then yeah, we're a lot closer to seeing sort of natural gas type pricing and oil, because it's pretty inelastic. Yeah.
Yeah, it's a very good white paper. I'll put the link below. And also, if you sign up to Ferg's newsletter, you can see it on his Twitter. It's right there on his profile. I'll put his Twitter handle below in the description. Ferg's newsletter has a collection of articles every week that he reads and finds interesting. Just one last question, because with the whole China situation, so we've got the Evergrande situation. People are worried about debt in China, that there could be contagion. No one really knows what's happening. If China were to crash or slow down significantly, how would this impact your views on the market, on the oil market?
Possibly could push everything out a bit. Like if you obviously have a sort of a global depression, it's going to push a lot of timeframes out, like kind of like what Delta has or whatever. But ultimately, it's just supply demand. We need oil once things recover. Yeah, that supply demand equation's going to matter sooner or later, and I think it's going to matter sooner. I also believe that there's quite a high likelihood that energy is the sort of thing that breaks a lot. Like I've kind of written about it a bit, that there's a really tight correlation between sort of oil as a percentage of global GDP. Once it gets above sort of 5%, 6%, then it generally causes a recession. And so I think everyone's quite focused on the whole China problem, whereas I feel like it's likely to be ring fenced. I've got kind of a saying, maybe I'm completely wrong and it all blows up, but when everyone's focused on everything and everyone keeps calling something the next Lehman moment, then because everyone's focused on it, it's kind of been solved. They'll be ring fencing and making sure it doesn't do too much damage. Like
and they have the reserves for it.
Yeah, slowly, like everyone that's bet against China has kind of been wrong. They've sort of a lot of the rules that everyone would think would sort of economic rules that they'd think would play out doesn't play out, because they can just close their capital account. They can do all sorts of crazy stuff. So it's I don't think it would never scare me out of any of the commodity trades, just because I just am have such a firm view of that supply demand story. Sure, there'll be a lot of volatility, but I've always kind of stuck to the statement. I think it's Bill Miller just said, volatility is the price you pay for performance. Even lately with uranium, it's just account bounces around sort of 30%, 40%. It's as long as you've got a serious amount of conviction on what you're holding, then it doesn't really bother me too much. Just don't look at it for a few days. So yeah, that's kind of my take. Is I've got really strong conviction on where this is all going. Well, what am I going to do? Am I just going to go to cash and sit there and hope for? I love the prices I'm buying everything at. I'm loving the sort of payoffs I'm getting out of everything. So sitting in cash is waiting for an even better price. Well, that makes no sense to me. I think that's greedy, and if everything turns out to not be as negative, and yeah, I don't see the sort of the need to try and avoid or hide from possible volatility resulting from it.
Cool. Clear. Fantastic. Ferg, thank you very much for your time. So people follow Ferg on Twitter. His handle is in the description below. Can you say 2 words about the Crux Investor Club you're involved in?
Yeah, sure. So I just do 2 videos a week. I usually try and find interesting people, a lot of sort of fund managers and people to chat to that I find interesting, and also just put up videos of trades I'm interested in or anything I'm finding interesting in the market. So I do that twice a week for on the Crux Club, just on the paid side. Yeah.
Fantastic. So the link is also below. Ferg, take care.
Thanks so much. I really enjoyed this. Cheers.